Hello and welcome to our State of the Economy, which looks a little differently than years past. Let me just start off by saying thank you for taking time out. This has truly been a crazy time in all of our lives, and to have you join us tonight means so much to us. We put together a phenomenal presentation. I think you're going to enjoy it. It's going to feel different, as I said, doing it virtually, but I think it'll be just as effective. So let me just start off by saying coronavirus 19, this COVID 19 time capsule that we're in has taken a lot out of all of us. I know that I've been sharing how we can, measure the people that have been sickened and people that may have lost some people close to them. And, I think we're all kind of in one of those moods where we're just ready, willing, and able, looking forward to when we come out from underneath this dark cloud. There's light at the end of the tunnel. We know that. We hope that the vaccine will be in all of our arms as soon as it can be. We hope that we'll get beyond this and the economy will get back to some kind of normalcy. I don't think our lives will ever get back to the normal lives we lived before COVID-19, but some of the good that comes out of this, I think, will be everlasting, and I think that we'll learn from it. We have Marty and Ryan will be doing our presentation tonight, and I think that you'll find it to be very good, and we'll have it up on our website soon after. So without any further ado, let's get started with the presentation. We ask you to email any questions you have. The instructions will be on the site. And if you have any questions for us whatsoever, we will get to them. So without any further words from me, Ryan, why don't you start it off and kick off the presentation?
Perfect. So from South Florida to upstate New York, welcome everybody. We appreciate you tuning in tonight. We are here in Saratoga Springs. We're at the Universal Preservation Hall. As you can see, it's not filled to capacity, unfortunately. We miss seeing everybody, but this is an amazing venue. We are thankful to the UPH, Teddy Foster and her staff to help set this up. Our visual and audio folks, TVI here, helping us out as well. And like I said, this is an amazing new venue. Just opened the February before COVID struck in March, but hopefully when we get back to normal, when we get the vaccines rolling out and we're in a more normal state of affairs, we can share this stage with all of you. And again, we welcome you here virtually, and so glad that you can make it and tune in tonight. I just want to echo off my father's point from before about emailing any questions. If you do have questions, especially early on, get them into the email invite that we sent out and the reminder that went out the last few days. We will be monitoring it, and any questions that come up, we'll try to answer those towards the end of the presentation. So again, welcome, and let's kick this thing off. So 2021, State of the Economy. Our live polling, we're going to do live polling like similar to last year. The best way to answer the polling questions is to text the number 22333. You'll be able to use that same text window as you move forward throughout the night. We have multiple poll questions we will be asking. And so you text the number 22333 and text the keyword BFG 2019, all one word, BFG 2019. And we'll run through those instructions when we get to a polling question. So the first section, hindsight is 2020, and for a year like 2020, it's easier now to say what happened, what do we see, some of the events that transpired, what the market was telling us, what the market did. As we look at it, so we have a question to kick off. So go to that number 22333. Text the keyword BFG 2019. Has your risk tolerance changed due to the COVID-19 pandemic. Text A for yes, I'm more conservative. Text B for I'm more aggressive. Or C, no, my risk tolerance is the same. And I think we had a few test questions early on, so that's where the answers came from the start of the poll. But yeah, answer, more conservative, more aggressive, or relatively the same after last year. And we'll give that a few moments to populate. Just before we went on, we were talking about New Year's Eve, and I feel a lot like Ryan Seacrest up here, going from different locations, going through the poll questions. This is it's a dream come true. So it looks like as the results are coming in, it seems that most folks, nothing has really changed. And I would say, having conversations with many of you out there, many of our clients, that rings true. I think I was sharing earlier today that I think we got more questions regarding the election than we did probably even through COVID. And many people are surprised to hear that. But looking back on the events of last year, I think that created more uncertainty, especially in some of the portfolios. So let's move on. So making sense of 2020. You got the bear, you got the bull, both in their masks. Now what? And many times last year, that's what it felt like. We were going through a global pandemic, the likes that we haven't seen in 100 years. And many times you're sitting there saying, well, what's next? What's going to happen? And now it's a lot easier to make some clarity of last year, but when you're in the moment, there are some difficulties. So one of the big themes that has come up is this disconnect between Wall Street and Main Street. And so let's try to make sense as to why the movements of the market made sense last year, even though there did feel like there was that major disconnect between Wall Street and Main Street. So drivers of Wall Street, I like this chart showing the weight of the top 10 stocks in the S&P 500. Going back 25 years or so, it's at the highest point it's been. Even the top 5 stocks in the S&P 500. So you have Facebook, Apple, Amazon, Google, I'm missing one, Microsoft. They made up over 25% at one point last year. And these were the drivers in the stock market. Not that any of these companies prepared themselves for a global pandemic, but just the nature of their business made it so that they could survive and do quite well during a global pandemic. And so those top 5 companies made up over 25% of the S&P. They made up about 80% of the total gains in the S&P last year. So they had a tremendous, tremendous impact. We've talked about these different types of recoveries. I think, early on in the pandemic, you heard about the V recovery. Was it going to be a U recovery? I thought it was going to be something along the lines of a W recovery. We get some recovery during the summer, but going back into sort of a hibernation in winter when the virus may come back. But what we're really seeing in terms of sort of the disparity right now throughout the economy is this K recovery, right? You're seeing, the companies that are doing really well, those 5 that I listed off, the top 5 companies in the S&P, doing great. Higher income earners really weren't that displaced over coronavirus and a loss of jobs. Where you saw the majority of the loss of jobs were in those lower wage earners. And that's where you see this sort of K recovery of one area of the economy doing quite well and the other seeing tremendous struggles. And of all the 22 million jobs that we lost, majority of them were in lower income earning areas. This just goes back again to talking about that breakdown of those 22 million jobs lost. We've recovered about 12 million, but there's still 10 million jobs that haven't been regained quite yet. And that's substantial. I didn't realize the numbers and the discrepancy, but going back to even 2009, which is the worst we've seen in close to 90 years, we lost 5 million jobs. We're at still 10 million jobs. And you see on the left the biggest driver, leisure and travel, and they've only recovered less than 60% of those jobs lost. That's going to be critical as we move forward. How do we regain those jobs? How do we get these people back to work? And those industries that had nothing to do with their business models or anything like that, they couldn't see this coming. We just hope that we can get to a point over this coming year of again, getting these folks to work and these business owners up and operating, it's going to be key. Some of the strength on Main Street. So again, this disconnect. With stimulus that went out earlier in 2020, 36% of those folks who were polled here saved that. Almost 35% paid down debt. You know, essential payments only accounted for less than 20%. That's pretty staggering when you think about it. And I think Marty will get into it later on in the presentation, but you know, last year we had record income numbers. You know, savings rates were super high. We had all these areas that you wouldn't think would be possible, but the stimulus in the Fed's intervention helped create more money being in the supply chain, more spending, more saving. It was really quite an effective use from the Fed, but that's where I think we're seeing sort of this economy being propelled and propped up through most of the year. So what are some of the major takeaways from last year, and how are we looking at it? You know, to a degree, the markets, even though it felt like there was a disconnect between Main Street and Wall Street, the markets kind of made sense when you see what drove the gains and really on aggregate how the economy did. Like I said, there are folks who are really struggling right now, but in aggregate, the numbers sort of support the strength in the stock market. We're seeing this K recovery. We have major upside in some cases for some, major struggles for others. The S&P performance, like I said, 80% of that was driven by the top 5 companies. And in aggregate, surprisingly enough, the U.S. consumer has never been better. Still many are struggling, especially a lot of small businesses, but major effect, and we're seeing a major effect on the federal debt, and we'll talk about that next. So what are going to be some of the lingering effects of last year in 2020? So we're going to go back to the polls. Text 22333. You can go to the same chat window you had open before. What is your confidence level in the economy for 2021? A, I think the economy will do well once the vaccine is distributed. B, even with the vaccine, I'm concerned that the economy will struggle. Or C, there are too many uncertainties to make a prediction. Give that a few moments. I don't know if we only have one individual who answered this, or if everyone thinks the economy is going to do better once the vaccine is distributed. And as we've seen that, especially in New York, that may be a long time coming. I think there's some struggles so far, but hopefully they can get it moving a little bit better as we move forward. Some concern. Yeah, and I think as we move forward, and again, we'll talk about it later, I do think one of the major concerns is going to be how many folks are still unemployed. I mean, that number is very high. But most folks feel confident that once the vaccine is distributed, that's going to be the driving force of a strong economy. So let's talk about the stimulus impact a little bit. You know, we have Jerome Powell here. Yeah, pretty sure it broke, talking about the S&P, and that's really how it felt back in March. And you know, the Fed's intervention, you cannot minimize the impact it had. We've never seen anything like we did, not during the Great Depression, not during the financial crisis back in 07 and 08. We didn't get Fed intervention until 2009 when the economy was sort of coming back around. The intervention that the Fed made last year was critical. It helped propel the economy forward, but it is something we've never seen, and it'll be curious how that impacts moving forward. Let's look at the Fed balance sheet. I won't spend too much time on it, but obviously over the last 20 years or so, just in the last less than 12 months, we've doubled the balance sheet, both with the $3.2 trillion stimulus earlier last year, another $1 trillion towards the end of this year. We've put a lot of money into the supply chain, and you can see how much that grew just over the last, like I said, 12 months and in the forecast to come. 2021 budget, where is the money going to come from? So we got about a $5.1 trillion budget with about a $1.8 trillion shortfall. Obviously, that's going to add to our national debt. It's hard to say the exact impact from a long-term perspective, but obviously we need to find a way, you know, how are we going to get that money? The good news is with low interest rates, the payments as a percentage of, say, our GDP, it stayed relatively flat. But if we see higher interest rates in the future or this number growing, that could be a real concern as we move forward. We'll do one more question during this section. Did you get a stimulus check, and what do you plan to do with it? And this will go along with a little bit of kind of what we're seeing in the economy with some of the stimulus spending. So A, plan on spending it, B, saving it, or no, did not receive a stimulus check. And like I said, I mean, we've seen the staggering numbers across the country of how much is actually going to savings, going to paying down debt. You know, based on that one poll, less than 20% was going towards essential goods and services, which is quite staggering given, you know, the challenges that many faced last year. I do think, you know, we had the stimulus checks, but I think what a big help in the economy too was that additional unemployment benefit. You know, when you look at all the different areas that the Fed pumped money into the economy, that was a big one as well, and that helped many folks get through some of the struggles, especially when you see, you know, most of the job losses were in some lower income earning jobs. That extra stimulus had a major, major impact. So a lot of saving, a lot of people saving. That's really pretty high. And again, that goes in line with the national poll that we saw earlier. That's quite interesting. So let's talk a little bit about stimulus. And, you know, the biggest fear right now with as much money in the supply is inflation moving forward. So this shows the M1 and the M2 money supply. You can see the strong tick up back in March. That stayed strong throughout the year. You know, good news for those worried about inflation. You can start seeing that taper off a little bit. That may be a good thing in terms from an inflation standpoint, but you can see how much more money was in the supply chain, and that velocity of money going through the system had a real big impact, and it was driven by that Fed back in March. Inflation expectations. So expectations are rising. There's no doubt about it, but even now, those expectations are still in the low 2%. So we're going to see if we get there. That's going to be interesting to see what the Fed decides to do. The Federal Reserve's mandate, again, is to keep inflation around 2% and the unemployment rate low. So, I mean, that's going to be, it'll be critical to see what interest rates do if we get a tick up in inflation. But again, when you look at 2% on a historical basis, it's not all that high. It's well below even what the last 50-year average has been. The last 50-year average, a little bit under 4%. If we're at 2 or a little over 2%, it's not going to be a huge drain on the economy. And, you know, I think moving forward, it shouldn't be too worrisome. I think we know the two major areas of inflation, and for folks that are going to be in that category, certainly should be aware of healthcare spending and college costs. I mean, those are the two areas we see inflation the highest, but through the rest of the economy, probably not as much of an increase as some may be worried about. Some of the real estate shift and dynamics that we're seeing. Almost 40 million people, tenants of renters, are at risk of eviction right now. And again, this just goes back to that disparity of the folks who are doing really well and the folks who are struggling right now. And when you see that many people potentially struggling to pay rent, not only does it affect their situation, but the landlords, you know, potentially the banks, and how does that play out? On the flip side, residences are just the builder expectations sky high, inventory super low. So I think we will continue to see a rise in real estate for single-family homes as we move forward, and that's been a big impact from this last year, and I think we'll continue to see that as we move through 2021. So some of the 2021 in moving forward trends that have been impacted through COVID, the Federal Reserve's new role within the economy. Again, when you think about what they did last year, that's going to be a major backstop with equity markets potentially moving forward. You know, we get some sort of pullback or recession, you know, we're going to be asking our elected officials, hey, can we stimulate this economy? What's going to be the long-term cost? It's going to be there. We'll see how that plays out. The average U.S. consumer can propel this economy. A lot of that is in place for the consumer to do quite well moving forward. And that could be, a big tick up for stocks as we proceed. Inflation concerns may be, in our mind, a little over-exaggerated. It'll be there, but I don't think it's going to be a huge concern. In that real estate market, again, we're seeing some winners and losers there between multifamily, single family, and I think we'll continue to see some price appreciation in those single family homes. So my last part I want to talk about is a question that you kind of see, or maybe headlines of, shades of the 90s and the tech bubble of the 90s. So, bubble concerns, and we've got a psychiatrist looking at the markets, and your problem is you're crazy. And I think this last week was a little wild in the markets, and we'll talk a little bit about that. But, we saw some craziness, maybe some pockets of bubbles, so let's tackle that quickly. Here we have, this changed maybe a little bit this week, but they're still up for the year and probably are the market leaders. But you have a brick and mortar video game store leading the market, even though most video games have gone digital. You have a nearly bankrupt movie chain that had a huge rise last week. And you have a digital cryptocurrency named after a dog all taking off. And when you see stuff like that, when it just doesn't really fully make sense, it does get you concerned about, hey, are there bubbles out there? Should we be concerned about this market, especially at all-time highs? So I think last year, there's been a huge uptick in the retail trader. And you have the Robinhood apps. They were in the news last week. But do not discount the fact of stimulus checks coming out last March. Believe it or not, even having less sports out there and having that gambling fix through professional sports or college sports, when they were gone, people got into the stock market. They started trading. They started learning to trade. That had an impact. And we saw the rise of the retail trader having a big impact on pockets of the market, especially the last couple weeks. Stocks, if you look at charts, I would say stocks are getting a little frothy right now. They're a little bit higher than average historical in average pricing. This is just looking at the PE ratio. We're certainly above kind of what the historical norm has been. In those top 10 stocks, again, they're driving a lot of this. But, given how well some of these companies are doing, I don't think we're at the point where we need to be super concerned of a full-on bubble. But, just being aware that, stocks are a little, maybe slightly overvalued today on a relative basis. The good news is when you look at the .com run-up, the 5 years leading up, the NASDAQ was up almost 500%. Just the top FANG stocks right now over the last 3 years are up only, close to 200%. The NASDAQ as a whole is only up 83% over the last 3 years. So we're a long ways away from that .com run-up. And lastly, just want a reminder of just, when you're an investor, I know it can be hard to put money to work in all-time highs where the market is today. But if you're an investor, if you're really investing for the long term and you're not speculating, you look, as you go further, on a daily basis, you might have a coin flip chance of getting the markets right. But the longer you go, 1 year, markets are up 75% of the time. 5 years, 88. 10 years, 95%. If you're an investor and you have a long-term time horizon, you shouldn't be that scared of getting money to work. It's just about how do you do it. And as we always say, we can help you with those decisions. So just, as a quick recap, retail trading causing major headlines, isolated to some areas, but not the entire market. We've talked about these top stocks are driving a lot of performance overall in the markets. Overall market is getting frothy. We don't feel as though it's in a bubble, maybe some pockets of bubbles. But lastly, as I mentioned, all-time highs shouldn't prevent you from getting invested. So with that, I'm going to turn it over to Marty Shields.
It's great to be here with you. I miss not being in person with you, whether it be in meetings to see you in person or a year from now, hopefully, at a State of the Economy, whether it be a dinner or a lunch, to see your smiling faces, to have conversations with you. I speak for my colleagues that that's what we really enjoy and we appreciate. That means a lot to us. So it's unfortunate we can't do that, but again, it's great to be here in this hall. I think they pulled away so you could see the size of this hall and how amazing it is. Teddy Foster and her team did an amazing job. They put $14 million into this hall to put it in pristine condition. I will guarantee you that you're going to want to come here to see a show or some sort of live performance because it is just an amazing venue. and it's going to be a real addition to the capital region. But we're here today to talk about some economics and finance in the markets, and I'm fortunate to kick off the next session, which is to talk about how does this market keep going up? What is going to be the drivers of it to move it forward? And, you know, really, we're going to go to the next slide, and we'll talk about that with this cartoon. If we're on the next slide. Thanks. And so with this bull market, he's coming in the door. He said, "I'm home, honey." And he's got all the bags and the little dogs there waiting for him. So hopefully this bull market will continue. And let's kind of talk about what's going to drive it higher. First and foremost, it is the vaccine, right? It's the vaccine, it's the vaccine, it's the vaccine. So if you can answer this question, do you plan on getting it? Have you got it yet? And how many doses have you gotten? Let's see where everybody stands. This is so important from my perspective of our ability to get back to a more normal situation. It's going to be based on whether or not we can get the vaccine rolled out properly and whether it's effective. And that is just going to be key to us getting back to doing the things we want to do, going to restaurants, coming to halls like this with lots of people. And, you know, hopefully maybe by this midsummer, we'll be able to do it. We'll have to see, at the very minimum, you know, a year from now, we'll be able to fill a hall like this with people. So we'll have to see how it goes. Looks like a lot of folks haven't got it yet, right? I see now we're at 18% who've gotten the both doses. So, you know, when I talk to a client or anybody that has gotten the vaccine, I tell them congratulations, because to me, that's a momentous occasion, right? That is something when I do it with my family, it's something I'll remember, because if we didn't have the vaccines, we'd be in a tough spot. So looks like we got a lot of folks that still need to get the vaccines. So we'll see how that goes, but that's going to be a real positive that everybody gets it. And this next chart just shows you, if we're looking at the how effective it is. So the top line, the blue line, is the placebo, the folks that took the vaccine, but it wasn't actually the vaccine. The light blue one is those that got the actual vaccine. And what it does is shows you on each day out from when they received it, how effective it is in the number of positive tests. And what you see is on day 14 is when they start to diverge, right? Vaccine, that's really when it becomes effective, and this data shows that out. So very important that, you know, that data continues to be the case, that showing having the vaccine is showing to be very effective, and that allows us to get back to doing the things we want to do. So the other element that really can kind of get us back to normal is the amount of money that's been saved, right? Ryan talked about the divergent paths and kind of how this, there's been two elements to this economy, right? There's been folks really who have been hurt tremendously. They've lost their jobs. They're struggling to put food on the table. They're really in a tough spot. And then there's been other folks that, you know, have been able to hold their jobs, that have actually been saving money because they're not going out and spending it on meals or entertainment or traveling. And the savings rate for the country has actually increased, right? So when you get past this point where everybody's gotten the vaccine, you're going to see a lot of pent-up demand get released, and that's going to be a real strong propellant for the economy. And from the market's perspective, the market's looking forward 6 to 12 to 18 months, and that's what it's already calculated in place that that's going to happen. You know, when you look at what, you know, real estate here in the capital region, year over year, prices were up 7%. Number of sales were up 7%. And as this chart shows you, that pattern holds across the country. Across most markets, real estate had a great year last year. And, you know, expectations are that this will continue. As Ryan mentioned, the supply of housing is very low. So from a builder perspective, this should be a very strong market. And we talked to local builders. They say that the pipeline for 2021 is very strong. So, you know, for any of those who've bought or sold homes, you know that there's a lot of ancillary services and purchases that you're doing through that process. And that really is, again, going to be a real strong tailwind for the economy. You know, we talk about the importance of technology and what that means to so many companies and industries and what it means to our company and our firm. And we're really at the beginning of a transformation, a revolution in technology. And that is with artificial intelligence, whether it be autonomous driving cars or trucks or AI in medicine. It is going to revolutionize how we all do business and live our lives. And as this slide shows you, it really is going to be one of the 6 major technological revolutions of the history of our country, and the most recent one being with telecom and computers back in the early 70s. And you think about how that has changed us and how we operate. And I think we're in the beginning stages of this. So really from an investment perspective, when we're in these stages, there's a lot of money that flows into these companies, these industries, and it really is a powerful thing for the markets and an investor. But, as in most things, there are going to be some challenges that we're going to face for this market to move higher. The first one, as Ryan mentioned, is valuations. So right now, valuations are a good bit above normal right now. This is looking at the forward PE for 12 months. And, two things. One is, more people lose money being scared about a bear market than the actual bear market itself. So, the thing to understand is, yes, right now we're at higher valuations, but really, the key to where do we go with that is, do profits actually grow, right? So this next chart shows you that we did have a sharp decline as circled with the red circle in 2020, but expectations for 2021 and 22 are for profits that continue growing. And if that happens, then the valuations that I just showed you before are not a problem. Everything will kind of get smooth and flattened out from there. But this is the linchpin. Can companies grow profits as are being forecasted for the next 2 years? Ryan also talked about the labor markets and how important that is that people who are unemployed right now get back to work. This chart shows you that from 2010 to 2020, there was 22 million jobs added over that 10-year period. Within a matter of 3 months, those 22 million jobs were wiped out. So we brought ourselves back to where we started in 2010 in just 3 months. Since then, we've added about 11 million jobs, so we've come more than halfway back, but we still have another 10 or 11 million jobs to add. So we're at an unemployment rate of 6.2%. We were at an unemployment rate closer to 4% before the pandemic. So again, we need to get these folks back to work, and hopefully, again, with a vaccine in place, that is something that can happen. Because we talk about this every time we do our presentation. The GDP, the economy in the US, is made up of 2/3 but from consumer spending, right? So you need to have consumers out there spending, and the only way they're going to be doing that is if they're working. So this is the other linchpin of the success in their economy getting back to normal and the markets getting back to normal. The other element with this is consumer confidence, right? If you're not confident in either what your job is now or what your future job is going to be, you don't have a lot of confidence to spend. So you can see by this chart that confidence had been building since the Great Recession of 08, 09, and then it took a sharp decline. So with that, it's got to start building back up, right? Folks got to feel comfortable that they can get back there and get spending. Let's talk a little bit about how we have the portfolio's position for some of these factors that we talked about, and making sure that, regardless of what happens, whether we have that growth or, we have some weaknesses, the portfolios are positioned properly. So in general, there are two main types of investing that you hear about. One is investing in growth companies, right? These are companies like your Amazons, your Googles, your Microsoft, really fast-growing companies. You pay a lot for those companies. What is called the price-to-earnings ratio is very high. So you're willing to pay a lot because they're going to grow very quickly, right? The other style is called value investing. With that, what you're doing is you're buying companies at a discount, and you're hoping and you're expecting that those companies are going to grow quick enough that that discount is going to make it worthwhile to buy those companies. In general, over the last 10 years, growth has strongly outperformed value, right? And that's what the chart that was up there showed, which is the black line is the growth, and that has substantially outperformed the light blue line, which was value. These things tend to go in spurts, right? They can take 5 or 10 years that one of them can outperform the other. We've been highly allocated to growth with a lot of our technology names. But last year we started adding some value to the portfolio because, again, we don't know when that's going to switch, and we still like those technology names, but you could start to be in a position where value starts to do well. So we've been adding value positions to the portfolio starting last year. The other thing we talk about is, when a portfolio grows over time, it's because of price appreciation, right? The value of those funds, those companies, increases because the cash flow and the profits from those companies goes up. But the other element that is as big a driver in the appreciation of your portfolio are dividends, right? So this chart basically shows you the dark blue is if you invested in 1979 in the S&P and what the growth would be over that time period up to 2019. The light blue behind that is what the dividends would be added on top of that. So reinvesting the dividends back into the portfolio and what would the overall value of your portfolio would be. So what you can see is at the end, it's actually 3 times as much of the value of your portfolio if you take those dividends and you reinvest them. And it just stresses the importance of dividends in a portfolio. We have dividends coming in through many different funds, including the broad market, but we also have a couple funds that are specifically companies that not only provide dividends, but they grow their dividends on a consistent basis, right? So these are great companies, very solid companies that will do well in an up market and in a down or a flat market, and they have consistently grown their dividends, which, as the chart I went through showed you, this is a real value to be able to see this over time and what it means to your portfolio. The other element with this is we're overweight in technology, which we've discussed, but we're also, as of this summer, overweight in financials, right? And there's a number of reasons for that. One, when the economy's doing well and people are starting new businesses, and last year actually saw the highest number of new businesses applications since 2007. When that's occurring, banks are lending money. Business is good for them, and that's what we hear when we talk to local banks. The other thing is when banks are taking your money in, they're not giving you much, right? You're not getting much for a CD or money in a savings account. The rate that they're charging it out, and that difference, that's where they make the money, right? And that difference right now is at one of the highest ranges it's been. So even though the rates that the banks are lending you money in is very low from a historic perspective, relative to what they're paying you as putting your money in the bank is a large amount. So that's really good for banks. The other thing is this graph shows you that the banks in general tend to move with the U.S. Treasury rate. And you can see that they dropped quite a bit last summer, and that's when we made the allocation in the financials, but they're starting to move back. And over time, Treasury rates will move up, and that will be a very good thing for banks as well. So financials are in a really good position to take advantage of the current situation. Let's go through a few things that you should be considering from a financial planning perspective in your own personal situation. So, we get this question all the time. I have cash, I want to get invested, but the market's hitting all-time highs. I don't know if this is a good time to do it, right? And, I think the main question you have to ask yourself, are you a long-term investor with this money? That is the most important thing to ask yourself. Can you have the right time horizon to put this money into the market? If you do, that next question of, oh, well, is this the right time, meaning is it if the markets are low or high, is rather irrelevant. And actually, this chart comes from a blog that our colleague Harmony Wagner put together, a great blog on just this story. And what this shows you is if you would invest money either randomly on any given day, or if you're invested when the market is at an all-time high, at any point from 1988 up into the present, that the 1, 3, and 5-year performance of those 2 investment periods for both, again, investing when the market's high and or any given year, any given day in any given year, the investing when the market's high actually gets you a better performance, right? So, what my colleague Steve would say is, hey, listen, this is great. Markets are all-time high. Let's hope it keeps happening. But from an investment perspective, this is a great time to get money invested, as the chart showed. The other element that's very important, we get this question is, hey, I'm getting older. Isn't it prudent to lower my risk, right? Isn't it prudent? I heard that it should be something about whatever my age is, that should be my allocation to bonds and stocks. And that used to be a good adage to use, right? But what this chart shows you is, when you look at a historical perspective and some of those rates of return that you saw and what is expected as we move forward the next 10 years, they don't really line up. Now, the one under the blue circle, what that's showing you is with equities, right? U.S. and international equities. The expectation is we might not see returns as great as we saw in the prior, well, certainly the prior 10 years, which just saw really stellar performance. So I think it's important to understand that, hey, it's a forecast, it might be right, but we might not see equities perform quite at that level that we saw in the last 10 years. But I think when we talk about bonds and cash, that is more important because that is probably much more accurate, right? With interest rates as low as they are, and really, I mean, you look at what you're getting paid for with cash, it's pretty close to zero. What you're going to earn on those more conservative assets over the next 10 years is going to be far below what the historical averages are. So, you know, along those lines, what it might have worked back in the 70s, 80s, or even 90s, which is to become much more conservative as you got older, it really doesn't work now because you really get paid almost nothing for taking on less risk. And the other element, too, is, you know, with bonds, if interest rates go up, it becomes a problem because the value of your investment actually goes down. So a few quick things to consider from a financial planning perspective. One, make sure you have a financial plan in place. That is so important. Really want to stress that. Two, student loans. Right now, you don't need to be paying your student loans, if they're from the federal government, until September of 2021. So I would definitely you know, also prevent you from consolidating those loans if you can, and keeping them with the government because there could be relief with those. You know, if you're going to be taking a required minimum distribution, and this is going to happen this year, and you're 72, another option is to take a qualified charitable distribution, and that is be able to give money to a charity and not to pay taxes on that contribution. The other element is to fund a charitable donor fund, right? So this is when you take money that you want to give to a charity, but you combine it, so you maybe put $5,000 or $10,000 into a donor advised fund. You can use highly appreciated stock, and then you can donate that money from there to the charity. So this is a great way to be able to take advantage of a deduction that many people can't because they do the standard deduction. What we're seeing a lot is when folks are looking at either taking a pension or taking a lump sum distribution, that the lump sum distribution looks much better than the actual annuity payout. So I would have you look at that and consider the options. The other element is, you know, it's small numbers, but it's still good to know that for 2020, you can take a $300 deduction for any charitable gifts that you gave, even if you're taking the standard deduction. For 2021, that amount is $300 per tax filer, so $600 in total for 2021. Again, you can take that deduction even if you filed your standard deduction. And just real quickly, as far as what are some of the potential tax changes that we're going to see, again, the likelihood of these happening in 2021 is probably not that great. It's probably going to be a 2022, and it's going to be very unlikely that they're retroactive. So first, there's a good chance that the SALT, the state and local taxes, will actually, the cap of $10,000 will get removed. That capital gains will go up if your income's over $1 million. So right now that would be at the 20% rate. So it'll probably go up to the 25% rate. That from an estate tax perspective, that the exclusion amount would go from 11.7 where it currently is down to $5 million, right? So again, many of these are for higher income earners, larger estates, but something to consider. For the increase for the Social Security payroll tax of 6.2%, right now that caps out at $142,000. It's going to go up to probably $400,000. So that's going to impact a lot of folks paying additional taxes. And then finally, there's a step up in cost basis. So again, this is really only if your estate's over $2.5 million, but that means if you have a taxable account that at the date of death, instead of getting that step up, that basically you're going to retain the original cost basis with that. So it's important to know from an estate planning perspective. Well, folks, we're going to move on to closing thoughts, and Steve's going to take it over from here. Thank you.
Thank you, Marty and Ryan. You really pointed out a lot of things. I'm sure the audience appreciated it. And let me just come to the end with our presentation with some of the slides that I think are important. So the first one is stock market resiliency. And basically, this just shows you that no matter what happens in the stock market, stocks go up. And we always say, I guarantee every client that they will lose money, because if you're invested properly and you have money in the stock market, not only do stocks go up, but we're sure that they go down. The funny part of it is when you look at this slide, you see how no matter what has happened in history, going all the way back to 1918, the Spanish flu was the big global pandemic then, and we had the Great Depression, World War II, presidential assassinations, regional wars, oil embargoes, the 9/11, the dot-com bubble, and the Great Recession 12 years ago. And now we can add COVID-19 to the list of events that have happened. And the stock market recovers from it all. If you go back just almost a year ago, when that stock market dropped in 3 short weeks, 34%, everybody thought that the world was going to end. And within 3 weeks, the stock market bottomed out and came back over almost 75% at this juncture. So stocks go up, stocks go down, stocks always go on to make all-time highs. When we go to the next slide, one of my favorite slides, again, is the slide that basically shows market declines are normal. When you go back and you look over the last 41 years, 31 of those 41 years, the stock market was up. The stock market's always up more than it's down. And the average intra-year decline in the stock market, high to low, peak to trough, the swing in the stock market year in, year out is about 14.3%. And this chart shows you that, the market's up and you see how the market is down. And the market can be down a little bit or a lot, but on average, 14.3%. So when you see that volatility, it's nothing to be afraid of. It comes with the territory of investing. And then when we go to the last slide, it's time, not timing. When you look, the olive green chart is stocks, the bluish chart are bonds, and then the gray chart is a 50-50 portfolio. The first, when you look at the 1 year, you can have stocks up as much as 47% or down 39%. That 39% happened during the Great Recession. Bonds can be up as well, up 43%, down 9% in any given year. A 50-50 portfolio up 33%, down 15% in any year. So even though you have bonds in the portfolio, you can actually have some losses with those bonds. There's an inverted direction. When you see interest rates start to go up, the price of the bonds go down. Right now, it looks as though interest rates are at historic lows or close to it. So when you put it all in perspective and you look at the 5-year, 10-year, 20-year rolling averages of stocks, bonds in a 50-50 portfolio, with time, stocks become less risky. So do bonds. And the point is having a well-diversified portfolio long-term is good, which is one reason why we have any client who needs cash over the next 12 to 24 months, we take that cash, we put it off to the side so that when there's that 1 year that the market is really volatile, they don't have to worry. It doesn't affect their retirement plans. Those are 3 of my favorite slides just to remind our clients that stocks go up, stocks go down. In light of full disclosure, you know that 100% of my money, along with Marty and Ryan's, is invested just like yours. And I just turned the ripe age of 63. I'm 100% invested in the stock market. I'm very comfortable with risk. It doesn't bother me to have risk in the portfolio because I know that stocks will always come back and make all-time highs. Not that we want our clients to be invested 100% in stocks. I understand the risk-reward relationship. And most of our clients are either 60-40 or 80-20, and having that diversification is good. So those are the slides. If we can just pull up the last slide, the disclosure real quick. I want to go to a couple questions that we have. So one question is, my son has recently graduated from college. What is the best thing he can do right now from a financial planning standpoint? This is a great question. I was afraid when I started to read that question that you were going to say, my son is in high school and he invested in GameStop last week and he thinks that he doesn't have to go to work. He can retire right now. Well, I think Ryan went over that. If you like GameStop at $400 a share, how come you didn't like it when it was $4 a share just a few months ago in September? So GameStop went from $4 a share to $400 a share, and now we're under $100 a share. It's a crazy week we've had in the investment world. But going to what advice would we give? I'm going to give the same advice that I gave to both of my children. As soon as they graduated from college, our office, Angela Sesney, actually sent them some applications for a Roth IRA with a automatic have money come out of their checking account. Before they got used to spending that money, we had them fund the Roth IRA 100%. And as it turned out, Ryan is a good example. After Ryan was with Ernst & Young in Boston for about 7-8 years, and when he moved to Saratoga, he had a lot of money invested in that Roth IRA. He was able to liquidate some of that with very minimal tax consequences and use it as a down payment on a home. So this is what I try to tell anybody who will listen to me. When your children or grandchildren come out of college, before they get used to spending that money, let them put that money into some kind of a savings vehicle. In this way, when they spend what's left over, it's okay because they're paying attention to saving. And it's a lesson that we can all use. Another question was, what's your opinion on what may occur with the administration change in Washington? Well, I think Ryan or Marty pointed out, leading up into November, the election cycle, we had this question come up more than any other question. As Ryan said, I think nobody really asked us about COVID-19. What they asked us was, what will happen if the Democrats win the election, if the Democrats take control of Congress, if the Democrats take control of Senate? And that actually played out. It happened. And we told our clients, do not make any have any knee-jerk reactions and sell out of your portfolio. You definitely don't want to do that because the stock market will overcome no matter who is in Washington. It doesn't really matter. And with regards to the new administration, actually the stock market's up 15% or almost 15% since election day. So the stock market is really looking at the fundamentals, something that we say all the time. The stock market always pays attention to the fundamentals, jobs, the economy growing, the corporate earnings, which we're right in the middle of it. On Friday morning, we'll see what the jobs report was for January. And this is really what the stock market trades on. Everything else will just kind of create a little bit of volatility, but it's short term. And the last question, last year, the RMD, required minimum distribution, was postponed. Do you see Congress or the government allowing that again? We're not sure. Last year, they allowed that. It was a good thing. We went through some crazy times, and we'll wait and see if they do it again. Anybody who, because they did raise the age for RMDs, now you don't have to be 70 and a half. You can take your RMD at 72, so it gives you a little bit more time. Remember, the government wants you to take the RMDs because they get tax revenue. That's all income to you, and you're going to pay taxes on that income. And this is why the government is really, they would rather see you take these distributions than not. So that was all the questions that we had. I just want to kind of finish the presentation by saying thank you again for being with us tonight. Our team, which at the beginning of the presentation, we had pictures of everybody and some stories behind it. Marty pointed out, we miss you. Our team misses you dearly. We love seeing our clients, and not seeing our clients during this COVID time capsule that we're in. It doesn't feel good, but we know it's the right thing to do because we're protecting everybody. Our team has been working remotely since last March 23rd, and they'll be working remotely for quite some time. They're doing a remarkable job, not skipping a beat. We're able to take care of our clients' needs, and I think that's a testament to having a team that's second to none. And we do have a team that's second to none, and I'm very, very proud of them. Every presentation that we do, State of the Economy, I always introduce Mrs. Danahy. And Mrs. Danahy was our client, 105 years old. She'd be 106 in April. We lost her a couple months ago. And she would say to me, and this kind of puts it in perspective, Stevie, Stevie, Stevie. She always called me Stevie 2 or 3 times. And I would call her on her birthday and I'd ask her, are you going to have a glass of wine? She says, Stevie. She says, I'm going to have probably 2, maybe 3 glasses of wine. How do you think I got to be this old? And she also took the time to tell me, she said, Stevie, we're going to get through COVID-19. She said, I was born, I lived through the Spanish flu, the Great Depression, World War II, and everything else since then. And she kind of just has us remember that we'll get through this COVID-19. I started out the presentation saying that there's so many people that have been sickened, and we've lost some people in our small circle of family or friends. And it's just sad, sad, sad. We can measure that, but there's a lot of COVID that we can't measure. Depression, some people that are abusing alcohol and drugs, some people that may be abusing some loved ones, people that may be hurting themselves. And these are all immeasurable. And I always try to say, try to take the time and think about somebody who may be in isolation alone, that may use a little pick me up. Maybe call them, send them an email, a text, let them know you're thinking of them. Because there's a lot of people that are really feeling the effects of COVID-19. So as we see light at the end of the tunnel, we can't come out of this dark cloud anytime too soon. And there is hope on the way. The vaccine is here. We're getting it jabbed into our arms. And for those clients that are listening, if by chance you're having a hard time getting online, I'd like to extend. We have a service team that is remarkable with the computer, and they will help you. They would be more than happy to help you. So if you're having problems, give us a call. Let us try to help you. We would love to do that. So for now, I'd like to say thank you. Thank you for placing your trust in our services. I know that it means a lot to me. I can't tell you enough how we don't take it lightly. I apologize that I'm not on the stage with Marty and Ryan. I had some things that I needed to take care of in South Florida, as Ryan pointed out. I actually tried coming home. I hopped on a plane and I looked at all the people. Southwest lied right to me on the phone an hour before. They said, there's hardly anybody on the plane. I said, okay, then I want to come home. I want to be with Marty and Ryan on the stage. I got on that plane. I literally turned around and got off the plane. The plane was almost entirely full. I couldn't believe that Southwest would lie like that, but I just didn't feel comfortable flying with all those people, so I didn't. So we're doing this remotely, but this is our new world, doing things remotely. And with that being said, I hope you stay safe, stay healthy. Let us know if there's anything you need from us or anything we can do for you. Marty and Ryan did a great job. Marty and Ryan, thank you very much for putting this presentation together. David Clark, who's behind the scenes, he's one of our newer team members. He and Harmony worked on the logistics of this. And as we build out our team, we continue to invest in our human capital as much as we do technology. And we're going to have some exciting news coming for you real soon. So with that being said, let me sign off and say good night, stay safe, stay healthy, everybody.